2 years ago, debt market investors were calling Argentina, Ukraine and Venezuela the unholy trinity of emerging market debt, where the threat of default was considered particularly acute. Since then, both Argentina and Ukraine have defaulted, which leaves Venezuela. As a founding member of OPEC, the country depends on oil for 95% of export revenue, and as oil prices fall, the economy is suffering. Brent oil, the international benchmark, is down by more than 20% just this year. And in spite of soothing noises from Venezuela that it plans to service its debts, there are increasing fears that the government and its state-owned oil company are running out of money. The country's benchmark 2027 dollar bond is yielding over 22%. And according to Barclays, a credit event is on the cards for 2016 unless oil prices stage a remarkable recovery. On Tuesday, that looked unlikely. After a short-lived respite, oil prices resumed their slide towards $30 per barrel. Stocks are also falling and prices for safe haven bonds are rising as investors wait and see whether the US Federal Reserve is sufficiently worried about this market rout to intimate a delay in interest rate rises on Wednesday. With the likelihood of a Venezuela default high, a number of investors have already bought into the short-dated bonds, betting that the country can make payments due in the next few months. Cheaper, longer-dated bonds are less loved, although some banks have suggested they offer the best chance for investors to recoup their money in the event of a restructuring. What no one expects is that a Venezuela default will trigger a blow-up across emerging market credit. But as a commodity credit with lots of dollar-denominated debt, what Venezuela might be is a parable for other oil-exporting borrowers, but only if emerging market investors decide that oil is an asset that has been overvalued for far too long.